So when we look at the consumer, we want to look at expectations. What are they likely to spend on? And when you look at buying conditions for homes and cars, haven't gotten worse but are stabilizing. And I think that's likely given just where they are in relation to previous, going back to the 1980s. But as inflation fears get worse and you start to see rates going up and the ability to borrow or the cost of borrowing goes up in order to purchase some of these things, I think you're going to start to see the willingness to spend again falling down and coming under additional pressure. Then when you look at just taking an example and again, just trying to drive home where things are, the demand, Manhattan apartment rents continue to soar and have reached a new record with tenants paying a median $3,630 in February, up 28% from a year earlier. So that, again, you're just getting additional cost. All of these prices coming back, which just leads to that elevated level of inflation, additional pain that continues to roll through the system. And then when you look at that wage tracker and then the CPI, so real wage growth continues to hover in negative territory when taking CPI inflation into account, but the rate of change is improving. So now the question is, can wages start to pick back up? Because we know inflation's going higher again, at least in March following what happened with Russia, Ukraine. So there's going to be that impact. It's just how much can wages go up and how quickly. Now the benefit is hiring typically picks up between March and June. So all the people that are getting new jobs right now are going to be in a fairly good negotiating point from the labor standpoint, which we're still in a labor shortage. We're below natural unemployment, which means that you should see some of that wages catching up, but how much of it will be able to offset. So then COVID inflation adjusted real wage growth, that's where you see who is benefiting. So the low is still up there. But when you look at actual spending, the people that have the most discretionary, which is the high and middle, you can see that they're still negative, and then the actual all-in continues to be negative, weighing on those totals, which is why when you look at those real hourly earnings continuing to go negative, but then when you look at weekly, it's starting to bounce. And that's just kind of that backdrop of where we sit. And I think as wages go up and inflation goes up, we should see this go sideways, still negative, but at least stopping kind of this downward trend. But when you start looking at big spend periods, which is typically the spring into summer when people go on vacation, they go do things, high prices are discouraging purchases of new cars, homes, restaurant meals. When you go away, what is it? It's exciting. You get to eat out every night. You get to have different foods. Well, maybe you won't go as long, or you're not going to go at all, or you're going to do a staycation and do local restaurants. Some of these things are going to pivot, which is going to, again, hit that demand cycle and really start to weigh on things as we see the prices are too high, kind of continuing to grind and take more of that market share and more of that answering component. Then when you look at most consumers who are contemplating big ticket purchases, opted not to buy. New car, used car. Unfortunately, I wish I didn't have to buy a car right now, because for all of the reasons here and things that we've been talking about for over a year now. But then when you look at house and apartment, again, you're seeing all of these big ticket items, which is why we should see some of that slowdown in goods and those increases in services. And just putting it all together, there is not a single part of, the way you can spin the inflation narrative that isn't biting. When you look at core CPI, median CPI, trimmed, sticky, again, every single piece of this is hitting hard. And it's not, and a 0.25 or 25 basis point increase is not going to be the one to do it. Now we have the US 5 to 30-year yield curve extends flattening to under 25 basis points. This is the key one that typically kind of signifies if it inverts, it's usually a prerequisite to a recession. So again, all of the warning signs are just flashing everywhere. It's just, the market is back up, because why let a good rally go to waste when you can try to buy blindly? But again, these are things that continue to play out. And I think it's important to appreciate kind of where things sit right now and the pressure that we're really under. Then when you look at the inflation in general, so CPI inflation came in at 7.9% year over year. Same with the estimate. Month over month was expected at 0.8. core, everything came in with expectations, but again, we didn't see the true disruption. We saw some of it because people were kind of pricing it in. You were seeing prices start to go up, but the real actual invasion happening February 24th is going to be the biggest driver for where we are in March. And then core commodities component of CPI continues to soar and is expanding at the fastest rate since the mid-1970s. Rate for core services hasn't caught up as quickly, but continues to rise at the fastest rate since the 1990s. So one of the things here is when you look at that yellow line, consumer services less energy services, we expect that to continue to accelerate as the core kind of continues to come up. Flexible is going to flatline a bit, especially with gasoline starting to normalize. I think diesel is still going to be an overhang, but again, that's going to be one of those big pieces. Then when you look again at the University of Michigan sentiment, expectations through the floor, because again, there's that concern that's continuing to go up. And when you have numbers at that level, and look at 2011 when you had, again, the Arab Spring, you had food prices exploding, you had all of these problems coming up, you're not going to spend as much. And that's why I really have that concern on what we're going to look for as we come into summer spending. February PPI, 10% year over year versus the estimate of 10%. Month over month, right in line. Core PPI came in slightly better. Expected at 8.7, came in at 8.4. But again, it didn't pick up all of it. So again, there's kind of that pause, and we expect to see that reacceleration, and then hopefully some kind of stabilizing factors as we go into April. And when you break it down into its different pieces, U.S. core, just give you an idea, it's like it's pause, but we've seen it pause and then go back up, pause and rally back up. And that's something that I think is very likely to happen as we kind of go down this route and we continue to see these different pressure points. So then when you look at one of the first regional federal areas to report, March Empire manufacturing PMI sank into negative territory, negative 11.8 versus the estimate of positive 6.1. New orders fell to negative 11.2, and shipments are now negative as well. Work week and employment fell alongside increases in inventories and delivery times. 6-month outlook improved back in December, and now it's getting worse. So this is the first firm negative reading. Like, this is not good at all. The leading indicators are weak. The current ones are weak. And it's not like, we're bumping along. Like in February, we were at 3.1. And as we said, we're just slowing down, kind of bumping along the bottom, nothing to be concerned. This is something to be more concerned about. And the fact that new orders are negative, shipments are negative, those are leading indicators. All of those things point to, again, that kind of that screeching halt and a pretty extensive slowdown, which we see coming into the market. And then at the same time, while all of that is happening, prices paid still elevated and prices received new all-time highs. Prices received is what you pay, you the consumer. That's what they're receiving. And if it's business to business, again, passing on that cost. All of that is showing that inflation is going nowhere, and it's actually going to continue to go higher. And then inventory levels also going up, again, leading into that slowdown in spending, which is again putting more inventory in at these companies. And then the profit disappointments. Again, when you look at the Chicago business, we continue to see the stocks going back up, even though I guess people were assuming a more aggressive rate hike. Though Powell's going to do everything he possibly can to not spook the market, and that continues to be the case here. And so then when you look at median CPI, 4.6%, the highest since 1991, driven by wage growth at 5.7%, 6-month average, highest since 1983. And again, this is where you start to run into, are we getting into a wage spiral? And that's going to be the key. I'm going to talk about that a lot going forward, to see, are we starting to see it emerge? Is it just something to talk about, but we're not actually seeing a spiral per se? But those are going to be some of those important pieces, which is why the raise, what Powell does going forward is going to be so important to look at, trying to protect against some of these additional pressures. And then when you look at median CPI and then the NFIB or the small business actual price changes, you're getting those some of those different moves in terms of increases and those different pressures that continue throughout. So again, it's just showing you that price changes are going to continue to go up, trying to cover that CPI, trying to push those different price increases, which again is going to become a bigger issue. And then I thought this was interesting, given it's a small sample set, it's just over 1,100 people. But you always hear, people live paycheck to paycheck, but how many? And do you live paycheck to paycheck, meaning you don't have any money left over after covering all your expenses? 50% said yes. 15% said it varies. So that you can pretty quickly on an inflation side, especially if it varies, you can pretty quickly on an inflation side see this go into a problematic level. And you can see that go almost 65% of the people could be under pressure, could see some of these pressure points. And I think that is something that needs to be appreciated when we're looking at where inflation is and where wages are and how quickly we can get some of that spiral. And that's why the savings rate has collapsed to 6.4%, which is the lowest since 2013, and getting worse because we're still seeing prices going up, and those are things that have to be recovered. Now, bills Americans wouldn't be able to pay without their next paycheck. And I would still be able to pay all my bills, 34%, but rent or mortgage is at the top, phone bill, utility bill, all at the top of what could not be paid. Again, that is the problem when you're looking at some of these underlying balances. And then wage growth and inflation. So U.S. real average hourly earnings continues to kind of that turn over, and we just see that continuing to accelerate on all different fronts when you're looking at that ability to keep pace. All the while, we continue to import from the external world. U.S. trade deficit widened out to a new record in January of $89.7 billion from $87.3 billion estimate. So we're still importing all of these increases that we see. When you look abroad, there's so many other pressure points. There's so much out there that we continue to, again, import and see. And that's, again, another piece of where we continue to price out some of these problems. Now, U.S. wages stalled in February after months of strong growth, and that's something that, again, we're going to continue to move through. It's just another way to look at it because all of these companies and areas are looking at different metrics, and they're all showing something very similar. So small business hiring plans, orange, have rolled over considerably, while job openings that are hard to fill, blue, are off peak but haven't fallen as swiftly. So again, you're still seeing those hiring plans are starting to slow down, but jobs are still hard to fill. So you're just looking to fill what's there, but you're not looking to go much above that, again, creating some of those underlying pressure points. And then when we look at small business optimism, the expectations were for 97.3, came in at 95.7. Outlook fell to negative 35%. Expectations of higher selling prices have risen, and that percent of firms anticipating job creation fell to 19%. 27% seeing increased CapEx. All of the pressures that just lead to additional slowdowns and just the underlying problems when we're talking about global growth and U.S. growth in general. And this just puts into perspective where we are versus where we started coming into COVID. Hiring plans have come down. Again, you're starting to see that calm, but we're so far below the natural unemployment rate that you kind of have to have that transition back to the mean. So it's not too crazy to see that right here. As sales expectations have turned negative, CapEx plans have also come down, again, kind of moderating what the views are in the market in general. While small businesses are saying that they're raising selling prices, and then inflation is the single most important problem, as we've been discussing, and I don't think it's any surprise for those that go about the underlying issues in general. So price plans next 3 months kind of normalized, but still elevated. Compensation index, something similar. So you're not seeing it come down. We're not seeing deflation yet, but you're starting to see kind of that pause on how they're going to try to pass through, which then leads to margin compression and profitability coming under the gun. Now, when we look at retail sales, they came in at 0.3% versus 0.4%. And X Auto, they were at 0.2% versus the estimate of 0.9. And then the control group was weak. It came in at a negative 1.2% versus the estimate of positive 0.3. So retail sales control group the estimate was for 0.3, coming in at negative 1.2 is a huge issue when you start looking at kind of how are we leading into this? Because we had yet to really see the main impacts from some of the most recent disruptions. So now as more of this gets priced in, you're going to see additional pressure. You're going to see additional, some of that slowdown that we've talked about. And that's why when you look at the trade goods and services, it's coming, still we're importing it, but a large part of our imports still come from China. And as the U.S. slows, what is that going to do to Chinese exports? What is that going to do to China flow? And that's why we keep talking about the pressure that China is going to be under and is going to continue to be under as the U.S. continues to pare back. Then the revolving consumer credit has kind of slowed down, and it's again as people kind of adjust what they're spending on, how they're spending to avoid some of, I think, the biggest pressure points that we continue to see in the market. And then when you look at Atlanta Fed's flexible CPI continues to outpace sticky CPI by a significant margin, though the spread has rolled over slightly. And it's not because, flexible will come down a bit, but that sticky is really the one that is climbing higher. And that's where we see the most pain coming from. And then the average salary of job postings continues to go up, which is why I was saying those that are getting jobs now are going to be in a better position on wages, but that the company has to pay for that. And that's where we see some of that additional inflationary pressures as prices continue to rise to cover the higher wage. MBA purchase index, right in line with 2020, still elevated. Housing demand is starting to soften as rates jump, but then we've started to see that kind of flat line. We've seen some strength that remains. Redfin has talked about, again, still things not staying on the market that long, continuing to move through above asking price. So still, it depends on where you look. There's still a decent amount of upside when you're looking at sales. Median sale prices beginning to cool, some cooling in median home sale prices, which is up 17% year on year. Median list price has held firm at plus 15%, but is also slightly off the lower point. We just see it kind of sitting at this range. The spread between prices paid and employment components is widening in ISM services at a faster pace than ISM manufacturing. Inflationary pressure still evident in both indexes as employment fails to rise at the same pace, which again is something that we continue to look at and continue to highlight as really that prices paid point, because that's where we continue to see those upside pressures. Then when you look at a supply chain stress, according to the New York Fed, supply chain stress index fell for a second consecutive month in February. As we were expecting it to get better in January and February, which is why we thought we were going to see the pace of inflation slow. And it obviously did not come to fruition. And so we did get this piece right, because we did see the supply chain getting better, but now it's getting worse again, and you're seeing pricing come back in because of everything that we've been highlighting to this point. So ISM services PMI was expected at 61.1, came in at 56.5, so a big swing and a miss. Business activity fell to the lowest it's been since 2020. And again, all of these point to, again, the consumer doing less. And I think it's as people expect them to do more going into the summer months, I think that's when you start to see the biggest bite out of kind of that cut and run, just weighing into what's the activity that's slowing demand that we continue to talk about. New orders also came down, still positive, but falling. Employment is now negative. That is a problem when you start looking at where is the economy, the health of the economy in general, and kind of where can we go from here. And then inventory sentiment bounced, prices paid still near all-time highs, just slightly off all-time highs. But again, as we were saying, just going to go sideways as inventories start to rebuild, because when people aren't buying as much. So what happens? You get the inventories building back up. And this is just showing you on the unemployment rate and how we are now below what is deemed, natural unemployment, because you're always going to have unemployment. The question is always going to be how much, what are people doing? And this is just showing you where we are on that natural unemployment, which is the red line. And you can see that we're below it, which is, again, more reason that the Fed needs to get aggressive on raising rates. Labor market distribution, you're seeing everything that we have, not much has changed. When you look at employment costs, it's still hard to find a job. Hiring plans are still elevated. But when you get it, the initial claims, average hourly earnings continued to not kind of go to where the tightness would be. But again, some of these things continue to shake out in different ways. U.S. real personal income has now contracted 2 consecutive months, which hasn't happened since the beginning of 2021, and before that, the initial phase of the pandemic. Which then, when you start looking at average hourly earnings of 5.1% versus the estimate of 5.8%, month-over-month basis, earnings growth was flat. But you're starting again seeing that rolling over as we see that pickup in the margin, which is why when you look at the personal income transfer, U.S. fiscal boom is clearly over. Government payments now only make up 18% of personal income, down from the peak of 33%, but it's still elevated versus pre-COVID. So as we get further towards where we were to pre-COVID, that's going to pull even more out in terms of what is the savings rate, what is the coverage rate, and that again puts more pressure on the consumer and puts sends things lower. So that's what we have on the U.S. Now in the next segment, we're going to pivot a bit more into Europe and what is happening there, and especially some of the fallout from Ukraine, Russia.